Hello, everyone, and thank you for joining us today. My name is Nick Lowitt. I'm the VP of Sales and Development here at Peak Pro Financial, and we are going to run through the IUL War Zone. To me, this is a really important webinar for everyone to attend and glean some information from. And really just jumping right into it, there are a lot of challenges that life insurance has in front of them, let alone advisors themselves. We all kind of fall victim to this, whether it's the life insurance stigma, using industry jargon, transactional sales tactics. I mean, you are in an uphill battle against people just due to their limited knowledge of life insurance versus tax code. The big problem that we see here at Peak Pro Financial is the minimal education and guidance that is actually provided to financial advisors. And that means that a lot of times your information highway is fairly jacked up. Most people think life insurance is specifically for death benefit, and that's a problem too, right? I mean, we're talking about cash accumulation life insurance. Death benefit is typically the last thing that we're positioning for the clients in these equations due to the structure of a properly positioned index universal life or cash accumulation asset, tax-free, of course. You don't want to be seen as an insurance salesperson either. So that's another piece. But, the approach to index universal life is by keeping it simple and remembering that, tax code really needs to be positioned in the concepts, analogies, and proper language, keeping it on the level that your clients are going to understand. So in other words, avoiding things like modified endowment contracts, TEFRA, DAMRA, TAMRA, you got to name it. The industry jargon has to be kept minimal. The goal of this is to remember it's you and the client versus Uncle Sam. You are on their side. That is something I focus on with my advisors all the time is, really positioning and why we look at things like tax code 7702A or cash accumulation life insurance as an asset class diversification play. When we get into positioning index universal life insurance, cash accumulation life insurance is truly part of an asset class diversification play. Whether it's for tax-free income, that's actually one of the problems that I see a lot. It's just really getting into a position where index universal life strategies on illustrations are showing income on an asset versus using it to help control the uncontrollable factors of loss and taxes. So when we get into this again, one of the problems that I want to make sure we are addressing is AG 49. AG 49 really came into play in 2015. It was the first move for the NAIC to really come after dumbing down illustrations. But funny thing about that is there were certain carriers that were positioned to add multipliers and kind of get ahead of AG 49, turning them into some of the best-selling products in the industry at that point. You also had AG 49A in 2020, AG 49B in 2022. And what that really leads us to is the fact that you are all in this incredible picture here in basically an IUL war zone. What I mean by war zone is that the different regulations, different illustration rates lead you to a position where you get sent illustrations and you're shown one for 5.9% projecting income, shown another illustration for 7.19%. Another illustration for 6.6, and even one more run at 5.18. And the question you should be asking yourself when it comes to the index universal life illustration is which one is really the best for my client and why? To me, to Peak Pro Financial, when we really look at these contracts and we look at understanding how to analyze them, we look at three key points of analysis: cost, index, and cash flow, meaning loan structure. Without a proper analysis around these points, you really can't say you're holding a fiduciary's lens to the solution you're building inside of an IUL for cash accumulation. So we're going to focus in on a couple of these today. First thing, due diligence, analysis, we have to put it together. So let's build an apples to apples analysis. 60-year-old male, standard on tobacco, $100,000 a year for 5 years. Now you heard me right. 60-year-old male, standard on tobacco. Why? Because the vast majority of assets are being used or are really available in the 60 to 70-year-old crowd. That's where the vast majority of our plans are being placed. And if we're going to, work on these types of plans, let's work smarter, not harder. But we're going to take that 60-year-old male standing on tobacco, 100,000 a year for 5 years, income in year 10. And again, by the end of this, you'll understand why I don't like showing income on these illustrations. We're going to run everybody at 5% on the dot. So 5% across the board, probability of us getting exactly 5% inside of an index universal life or index investing product, slim to none, right? You're going to have zeros, you're going to have tens, you're going to have eights, 4.9s. It's just a carry illustration shows you a static return. So for that reason, we're going to run a second model. We're going to run a 0 in year 6 and a 0 in year 12. And there's 2 reasons for this. One, I mentioned, we get zeros. They do occur in index investing. It's part of the index investing methodology. It's a good thing. We don't have loss. However, we're talking about a cash accumulation life insurance contract. So every time that there is a 0, there is inherently going to be a fee for mortality, for the policy issue charge, for the premium charge. You have to account for the total fee structure of the plan. Now, when we look at these plans, they are long-term strategies. So we're going to break down that cost per year average over 20 years and make it really simple. Lower cost, greater probability to grow cash. That is the equation. Now, remember, that's just one part of the equation. So when we look at this carrier analysis, we go across the board here, my goal is to really understand the bottom row. And not every carrier is created equal when it comes to this analysis, right? If we looked here at just the income, skipping over, where we got to pay attention. Certain carriers are projecting higher amounts of income on a apples to apples analysis. But when you look at certain carriers, Pac Life here, for instance, if you look at the cash surrender value in this contract in year 20, it is a little bit horrifying considering the amount of cash we're taking out of the plan. For this reason, we have to really pay attention to, the structure of the policy, what it's built for, what's realistic, and how to use it. What can we count on inside of a carrier illustration when it comes to analysis? Can't bank on returns. They're not guaranteed. But what we can look at is the cost structure. Our goal is to keep the cost at 1.5% or less for this asset. And if I do that, I'm really structuring it well for cash accumulation. But, there are some pieces on here you're probably going to want to talk to us about. Give us a call so we can walk through more of kind of which carrier and why. But I want you to see the type of analysis that we can use and where we like to look at A+ accredited mutual companies and really pick apart why we can get this cost as low as we do. Now, when we get into the cost piece of this, every single one of your clients today, whether they admit it or not, are fee conscious. So we need to make cost part of the conversation. And if you're not, good luck with your review, because they're going to look at the policy you sold and they're going to ask you, what are all these fees? So again, we need to bring it up front. We need to make sure they understand the analysis and how we got to the certain cost structure we built. And remember, if you're a fiduciary, you do need to do the fiduciary work here. I do believe we are one of the only IMOs out there who's really looking at this with a fiduciary's lens and have come up with a strategic way to put these things together. Now, who's the right fit for Index Universal Life? I kind of mentioned this. Where's all the money today? Qualified assets. And who needs to make a decision sooner than later? Pre-retiree retirees. These are people that are looking to make a decision sooner than later, and typically their portfolios are heavily weighted in taxable assets. So when we look at the IUL positioning, we're really creating an asset to hedge against loss in taxes. That is the goal. Diversification for safety and consistency in returns. I mean, look, if we're controlling downside risk, it's more like sequence of returns risk that we're controlling. But I'd say too, when I go through the use of this asset, when markets are down and taxes are up, we need to have an asset that has control over those two so we can provide cash flow. I do believe there's psychology in the terminology too, meaning income is different than cash flow. You want income, guaranteed income riders, annuities, great solutions. I'd be building an IUL next to that to complement it with tax-free cash flow. Again, the moral of the story, control the uncontrollable. Have control over loss and taxes on a portion of assets in your portfolio. Strategic planning. Everyone on this call today who's thinking to themselves, I'm a holistic planner, comprehensive planner. Call me and tell me a new one. if you're not accounting for loss and taxes as part of your holistic or comprehensive plan, you're missing out. This is what we do. We work very well with advisors who are, again, comprehensive planners, want to help make sure the clients are best set for moving forward. That also comes into meaning there must be a sales process in place for an IUL. Education is key, and leading with certain bullet points of attributes versus me coming in here and talking to you about life insurance today. Every time I bring up life insurance with a client, they think of one thing: death benefit. Right? We're using the tax code to our advantage. So again, you need a good process to bring this up and position for clientele. Let me show you one of those positioning tactics. I'm going to look at the buffer account, our hedge against loss and taxes, 60-year-old males, standard non-tobacco. When we're looking at this, we're going to look at a qualified balance of $2 million for the client. We are oversimplifying the client's portfolio to convey a concept. We're going to transition 30% of that $2 million to an IUL over 3 years. We could do this over 4 or 5 years, but we've also found statistically that if we get that transition done sooner, we have a higher likelihood of funding the policy to the extent we planned on. Now, again, 3 years of funding, non-MEC structure. And when we go through this, we're actually going to leverage this contract to be able to pay the taxes on the transition from qualified money to the IUL. Now, we're not transferring qualified money into the IUL contract. Can't do that, but I'll walk you through it. Instead of using the IUL for income every single year, we're going to target a 4% income stream on the $2 million, and we're going to stress test this 2001 through 2018 sequence of returns repeating. Why we're doing this? We've got to make sure it works in a realistic worst case scenario. So let's look at these numbers together. The gray line in the middle separates the two assets. On the right-hand side, we have exposure to risk in the IRA. On the left-hand side, we have our IUL with a zero floor. 6 down years in an 18-year period trying to stress test the equation. If anyone is out there saying, why don't you just run zeros the whole 20 years? Well, you got a different asset to buy if that's what you think the markets are going to do. It's guns, ammo, and MREs, right? You shouldn't be investing in anything. When we get into this model, top right-hand corner is going to show us everything. We need $80,000 a year, 4% income off the $2 million, accounting for a 30% tax. What this means is that when we go to look at income, we're going to jockey between the qualified plan and the IUL, depending on what the market conditions are. Before we get there, let's talk about funding. I can take a withdrawal of $200,000 out of the IRA, put the funding into the IUL, and then instead of having to, and again, you can do this multiple ways, instead of me just paying the taxes up to $200, I'm going to take the full $200 and put it into the contract. The next year, I'm going to take a second withdrawal, fund the second year's premium, and have access to a participating loan to pay or reimburse for the taxes from the first year. Now, what's really important to understand here, this is one methodology of funding. Doesn't mean we have to fund it this way. Combination of cash on hand, to be paying taxes out of another pocket, all those things are viable. The core of this, though, is that when we're done funding the contract, we want to reduce our face value drastically while keeping non-MEC corridor. Again, call so we can walk you through it in even more detail. But here's where we get into the use of the asset. When the markets are up, we actually took dollars out of the IRA. When the markets were down, one of those golden rules, try to avoid withdrawals on top of down years, we built an asset to cover any income needs when the markets were down. We are hedging with this asset against two factors, loss and taxes. Now, I've had a lot of advisors go through this with me, and a lot of them will tell me, hey, look, nobody is 60 years old in the S&P 500 till the rest of their life. We manage assets, we take care of them, blah, blah, blah. Totally agree. But let me throw something out there. If your clients had more dollars over here because you managed their wealth better, and even more money over here because either we didn't have to tap into it or we had better returns out of a stress test, have you ever heard of someone's kids complaining that they inherited so much wealth and that a large portion of it was tax-free? Probably not. This is about doing your due diligence to help diversify a client's portfolio, bring more tax-free wealth solutions to the table, and is a fantastic fit. Now, to me, positioning this, you are positioning a tax-free bucket of cash. This is a cash tax-free cash vehicle that you're going to have on the sidelines to complement things like your management of assets, guaranteed income vehicles, LTC vehicles. So when I talk about that, we have to talk about the solutions you can use it for. What can you do with a tax-free bucket of cash? Just about anything you like. We could take dollars out over here, invest it in the market, take dollars back in, harvest it, use the same asset to pay for taxes on guaranteed income assets, cover long-term care without 2 to 6 ADLs. I mean, you kind of name it. You could even get as crazy as to say rent a Lamborghini and drive to Vegas. Like that's what this asset is for. It's for those conditions when markets are down and taxes are up. You have control on this portion of cash. So with that being said, Peak Pro has been around for over 20 years. We are really focused on unique solutions, strategies, and making sure we do our due diligence to bring all of these to the table for our advisors. If you've never talked to us before, I highly suggest reaching out to us. And just to make sure everyone knows too, we have some incredible marketing programs. We offer digital marketing where we can guarantee 25 appointments on a monthly basis. We also have seminars right now that are absolutely knocking the cover off the ball. So if you're interested in seeing more clientele, 55 to 70 years old, $1 million or more of net investable assets, give us a call. Obviously, we need to make sure you're really set up with our strategies and you believe in those to do our marketing. But again, just to hit home on some of these success stories, response rate over 2.6, 1.24, 1%. Just look at the commissions that were generated from these events. Incredible opportunities. If you are good at seminars, if you like them, I love hearing it. When you boast about I'm the best presenter that exists, call me. Let's see if you're right. Let's figure out what we can do together. Let's see if some of our core concepts and solutions can really match up. But give us a call now. Reach out. We'll have some content following up on this as well. I look forward to speaking with you here at Peak Pro Financial or any one of our sales development advisors here. And we look forward to hearing from you soon. Thank you again for attending. I hope you all have a great rest of your day.